Okay, good. All right. Hey, everybody. Welcome to Stock Trading Pro. On today's episode, we actually have David Trainer from New Constructs. David, how you doing today?
I'm doing great, Pete. Thanks for having me.
For those of you that know who David is, New Constructs, I would say fundamental analytics. I know that's very high level. Maybe you can give us a little bit more detail on that, and especially who you can help the most.
Yeah, no, New Constructs is for every investor who cares about profitability and valuation. Typically, our clients are folks who manage 10 million or more, but we have services and capabilities to serve everybody across the investing spectrum. Think about us as a robo-analyst, right? That's the way Harvard Business School referred to us when they wrote a case study a few years ago, because we're doing all that work, like in the filings and the footnotes, that nobody but a robot wants to do anymore. So when I was on Wall Street, Pete, that's how I learned to do this work. But that was before the tech bubble. Tech bubble came along, and then nobody really cares anymore about doing this kind of deep fundamental analysis. And the fact of the matter is, these footnotes that nobody takes the time to read because they're buried in a 500-page filing really do matter.
Can you give us an example of a footnote that does matter that maybe we know of but don't even pay attention to, like something that matters that, like, oh, you're not reading the footnotes? Give me an example of something that matters.
Man, here's a recent one. So we parsed AIG's 10K, and they report their loan loss reserve from going from 629 million to like 39.8 billion. Wow. And that's what's on their balance sheet. But then if you don't go down to the footnote on loans and reserves, you don't realize that included in that balance sheet number is a non-recurring one-time gain from a receivable from a business that they divested from. And if you don't make that adjustment, you're going to show effectively a non-cash gain of like $39 billion in your operating profit, right? So, on the one hand, a machine would probably go through and say, hey, I'm collecting that number. It is what it is. It's the number it's reported on the balance sheet. Maybe it's right. But our system is smart enough to say, wait a second, that number does not make sense. There's no way that the reserve would go from 629 million to 39 plus billion. But you don't know that if you're not familiar with the footnotes. And it's even a footnote to the footnote. The footnote has a table that shows the reserves, like the true reserves without the bad number. And below that, it says, no, we exclude 38 dot something billion related to the disaggregation or the divestiture of AIG FP and the receivable, blah, 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 that amount. And so, that's an example of a footnote. Harvard Business School actually and MIT Sloan wrote a paper that has a ton of examples because they prove in this paper that footnotes related to unusual gains and losses. And this is stuff that affects earnings. So what I'm talking about, loan loss reserves, maybe that's a little obscure and maybe people don't want to care about that. But everybody in investing, most everybody cares about earnings. Well, it turns out reported earnings, street earnings, adjusted earnings are not nearly as accurate as our earnings. And the differences are very material, like 20% or more on average.
Wow, that's a giant difference. Wow.
Yeah. And so that's a sort of broader example. And it's not us saying it, right? Pete, that's kind of, I think I want to make sure a lot of people in the research business, there's some firms out there, they toot their own horn really, really well, almost to the borderline of being illegal.
Actually, I was going to ask you about that. We're about to head into, and we'll talk about this in a little more detail, the earnings parade on CNBC and everywhere else that's about to be unleashed, specifically the banks, which we'll talk about in a second. What are your thoughts on earnings per share and how much weight everybody gives on just that one number, like the moment it comes out?
It's terrible, right? But look, most of these firms are in the business of selling advertising or selling stock or selling a narrative, right? I mean, that's what it's about. I mean, this whole idea that Jim Cramer is this media icon when he's just oftentimes spouting nonsense, right? But it's entertaining and it sells. And so, earnings per share is the wrong number. It's an incomplete number. It's a manipulated number.
That's a strong word, manipulated. Give us an example.
I mean, look, there's all kinds of evidence, not just stuff that we've written, but you can look up all kinds of things. I remember MarketWatch ran a story about how CFOs admit that they fudge the numbers by 20% or more, and that Wall Street ignores the fudge. And the fudge being, again, the inclusion of unusual gains and losses to make earnings look better than normal or worse than normal, right? In bad times, companies make their earnings look worse than normal or then worse than true because kitchen sink effect. Markets are unhappy, sentiment is negative. They just want to go ahead and get all the bad stuff out of the way so that when things get positive, well, they can show things to be even better than they are, and they can benefit from the animal spirits and irrational exuberance and have their stock go up a whole bunch so that they can in turn cash in on options.
So we're right now on our side of things, it's probably a little bit shorter term than what you do on the investing side. We're seeing money clearly rotating out of technology right now. I mean, there's still in some bullish order flow for 2023. And I think up at these levels, it's more not that they're broken as much as where's the upside from here. And so we're on our side, we're clearly seeing money shifted into healthcare in the last 4 or 5 weeks. Consumer staples picking up just a little bit. We're still waiting on energy after last week's OPEC announcement. They kind of gapped up. Crude oil hit that big wall, and they've basically been sitting there. So we're really on our side, we're focusing on healthcare and energy for the next wave. Ending last year, we kind of had a really nice, amazing rally in industrial stocks. Let's say October through January. January, tech stocks took over. So the way we look at things with sector rotation, we've pretty much been in a 7 or 8 month rally. If you understand how to track and follow the order flow and you're not fighting the tape, you're just following where the money is. What are you guys seeing on your side as far as some bigger picture stuff, maybe S&P 500 trends, anything along those lines?
Yeah, first of all, I love what you do with order flow. I mean, why not look at the future if you can, right? I mean, take a peek. I think that's a tremendous asset. We do some cool macro stuff. So I'm going to share my screen here, and one of the things we do is we have ratings on sectors, right? So you can see for the financial services sector and the banking services, it's an attractive rating. If we were to flip over to technology, right, we're not going to see as attractive, right? The returns on capital are really high, but the rest of the sector stats are not good. Things have gotten expensive in technology. And then we'll also look at trends, right? We can look at the return on invested capital across the entire market. This is for our all cap new constructs 2000 stocks index. And then we can break it down further and say, okay, well, which sectors are looking the most interesting? So for example, free cash flow is making a good, strong move, for a while here in the basic materials sector, but it's come way down and it's flat, right? The technology sector, right? And I think this was anticipated going into last year. It's also interesting to look at just how accounting earnings and economic earnings can diverge at the sector level. Here you see the industrials, GAAP earnings looking great, Pete, but the economic earnings taking a dive.
Could you explain that? Obviously, you and I have had multiple conversations about that, Dave. Can you explain the difference, high level, on what those two different types of earnings?
Yeah, absolutely. So GAAP earnings, accounting earnings, as I was saying at the top, Pete, they can't be relied upon. They're manipulated often. And whereas economic earnings, it's our numbers, so it's not manipulated. We take out all the manipulation. That's what the footnotes are for. But in addition, we're taking into account the balance sheet side of the business. So just think for a second, if you have two businesses and they have the same earnings, and one has got $1 billion worth of assets and the other's got $1 million worth of assets, well, which one is a better business? Obviously, the one that has a lot less capital needed to generate its profits, right? So economic earnings takes into account the cost of the capital used to generate the profits. So it's just a much more robust and comprehensive number. And that's a number that we pay attention to a lot. The main driver in it is return on invested capital. And we put enormous amounts of resources into making sure we get the return on invested capital number right. That's one of the biggest things we do.
Well, if you don't mind me asking, what's the difference between return on invested capital and return on equity?
Oh, yeah. Return on equity, first of all, return on equity is a very common and easy to get metric, which means you're probably going to be getting it from unscrubbed or even potentially manipulated accounting data. It's just net income over shareholders' equity. So you see it on a lot of websites. And so you're going to have issues with just a lot of manipulation and a lot of potentially erroneous data in general. But it's just net income. Again, that's sort of your earnings number, and that's not a reliable number. And then just shareholders' equity. So you don't really take into account the other part of the capital stack related to non-equity, that's debt and other long-term liabilities, and then net income, again, being a manipulated number. Return on invested capital, as we define it, is your net operating profit after tax divided by your invested capital. And if you're on our site, you can get deep explanations on how we calculate NOPAT and invested capital. Ernst & Young actually wrote a paper proving that we do that better than everybody else in the world. And in particular, they compared our calculations to Bloomberg and Capital IQ on a specific set of companies to show how different our return on invested capital number is from the other firms' numbers. And if you look at company numbers, it's what we do, Pete. I mean, you could call newconstructs.com return on invested capital.com, right? we want to get it right.
Okay. I guess, while we're talking about earnings, working our way through and balance sheets specifically, obviously the financial contagion exploded a couple of weeks ago. It seems like they haven't really recovered, but there's a lot of conversations about, well, we're going to fix FDIC and companies are not taking care of that. The customers are going to be taken care of. It's now the balance sheets of the First Republic and SVB, and it seems like they just took everybody out. Even Schwab got clobbered. I think it almost had a 50% haircut in that period of time.
No, it's nuts. I think you had some phenomenally poorly run businesses and regulators asleep at the wheel. Silicon Valley Bank, their balance sheet was so upside down that it's just hard to believe. Their chief risk officer left like 10 months ago or whatever. And they were so sideways with what was happening in the market and telegraphed by the Fed raising rates. It's just hard to believe that their regulators overlooked it. I would imagine they're all going to be fired. Who knows? They're in California, so maybe they'll get raises. But yeah, no, the regulators saw. I mean, they looked at the financials, and anyone who's looking at their balance sheet would say, "Oh, wait a second, you have all these super long-term liabilities or investments that you bought with these super short-term deposits. So that's dangerous, right? Because the deposit gets called, you can't call that money back. And then those investments were in 30-year mortgages, which, by the way, we're going to go down in value when interest rates go up. And in addition, you're going to see a lot less cash flows because prepayments were going to go way down. So it was like, are you crazy? Even if you think there's a whiff of interest rates going up, you need to like unwind some of that. They just leaned into it. So
yeah. I heard that they didn't expect the rates to go up that quickly, but I mean, gosh, read a headline. Everybody knew they were going to go up that quickly.
Yeah, no, it was they failed banking 101 for sure. And so I think, sorry to get so nerdy in the weeds there. I can't help
it. Okay. Do you think it's self-contained or do you think it's a bigger problem?
Yeah, I think that I think it's self-contained with respect to the bad banks and the bad businesses. And by the way, we need to see a lot of bad businesses go out of business, Pete. We need to see a lot of bad businesses go out of business. That's going to be healthy for us because the capital that's gone into things like Sweet Green and Silicon Valley Bank needs to be returned to investors so they can deploy it into good stuff, number one. Number two, the one thing that's hard to quantify, right, is investor confidence. And it's the confidence in the bank that caused the bank run. Right. That's a little bit squishier a topic because you never know, like when people could get scared and start freaking out and making a run. But I think
they're also blaming it on technology now that because of the speed of information and the speed of which you can now get your money out of your account, they were blaming it on, it would never happened in the old days because you couldn't have taken, that many people couldn't have taken their money out at the same time.
Oh, it's so true, right? I mean, like you can pull your money out with the click of a mouse as opposed to going and waiting in line and dealing with a teller. Yeah. And think about all the ways that like the old fashioned way and going to the bank, the time it takes you to drive there, the time it takes to wait in line, and the things the bank can do, right? They're like, oh, sorry, smoke break. You know what I mean? Oh, one of our tellers is sick. Hold on. You know what I mean? Or sorry, we've got a fire alarm or whatever. Like I do all kinds of stuff to make the branch not give out money. But yeah, today's day and age, it's scary how fast that can move.
Do you think, is kind of a little bit off topic, do you think reserve requirements have to change?
That's a deeper topic, right? So one thing for sure that's upside down is that too many of these financial firms and their executives in particular make money in the good times and the bad times. And they make a lot of money in the good times because they take more risk than they should be taking. And then when the bad times hit and they lose all their client and investor money, they walk away with bonuses. That's a problem. And I think one of the ways to address that is just to increase reserve requirements, tier one capital ratio requirements, so that they don't have as much capital to risk, just so that, they can't lose as much money, right? I'm just kind of trying to handcuff these folks from, heads they win, tails we lose, heads they win, tails we lose, because it's not fair.
I agree. That's why I brought it up. When you start to dig into it, and I'm not, I'm not as deep into the financials as you are, but just basic math doesn't work. That how little they can get away with having there, and then what they could do with it just didn't make sense.
No,
so that's the other side. What about, do you like anything right now, especially on the banking side of things? Because obviously financials are coming out this week. Most of the big banks on Friday. I guess maybe one thing before that. Do you think that there's a possibility? Because everybody's talking about, interest rate. We had the CPI number come out today. Interest rate, good, right? The dollar crashed today. We're going to lower interest rates. Let's even say they stop. I'm not going to go down the path that they're going to lower interest rates because inflation's still not even close to getting to that point. But do you think with this situation, there's a possibility that interest rates come down, but there's still going to be a credit crunch where they're not going to be as eager to be loaning out the same amount of money?
I think that's inevitable. I think that what the Fed is trying to do is to make this recession as shallow as possible, but they do need somewhat of a recession. And I think what they want is, as much as possible, more natural market forces to take capital away from the bad people and give it back to the good people, right? So Wall Street had too much capital, and a lot of individuals had too much capital. And it's not that they're bad people, but they're making bad investments, right? And so to the extent that the Fed raises rates, well, that raises the return requirement on your investment, right? You're not going to loan money out and expect a zero return if it's costing you 3%, right? Right. So you raise that rate, and that's going to put a gating factor on it. And I think the other major consideration is that as credit conditions tighten in general, is what we've seen, liquidity's gone down. Banks got to be more careful. Their portfolios are stretched because they maybe didn't position themselves as well as they needed to with rising rates. But they can't just go out there and just loan some company a bunch of money and assume that company is going to be able to roll it over with another loan and they'll get their money back.
I think that's the bigger picture that a lot of people are missing, because obviously the market, especially tech stocks in 2023, like we just talked about, had that beautiful bullish order flow for the better part of 3 months. NVIDIA, AMD, pretty much those are the top two. I mean, even Apple and Microsoft and Meta were carrying us. I mean, probably those 5 stocks made the NASDAQ seem a lot stronger than it actually was. And that was actually a problem as well. And I think a lot of people were leaning on that rally and saying the recession's behind us. It didn't happen yet. And interest rates are going to come down. But does it concern you at all that it was loaded up on just that group of stocks, and that same group of stocks that rely on borrowing money are going to have a hard time borrowing money? And I think a lot of people got ahead of what they think is over.
Yeah, no, 1000%. In our macro work, Pete, what we are seeing is that while the S&P looks fairly stable, right, in terms of cash flows, earnings, free cash flow, under the surface in different sectors, you're seeing a ton of carnage, right? Some sectors doing a ton of churn. Some sectors doing really well. Some sectors doing really poorly in terms of cash flow and valuation. And so, and this is kind of a thing we've had for a long time, actually, Pete. We call it the micro bubble. And there are parts of the market that are way, way, way overvalued, and there are parts that are more rationally valued. And so I'm not looking to say that we're going to look at it, we're looking at a huge, terrible crash and everything's going to come down. But to your point, these sort of lead steer stocks like NVIDIA and Apple and Meta and Google and some others, right? Those tend to make the overall market look much healthier than it really is. And there are a lot of small stocks smaller. We got 32 stocks on our zombie stock list. So, I mean, there's a lot that we think are going to go to zero. And that's a healthy thing. It's a healthy thing because that capital needs to be released from these money-losing entities to go into money-making entities. That's better for society. Because when it goes into money-losing entities, all this capital from investors around the country or the world, right, gets siphoned down to a few executives and bankers, and they go buy boats and villas, and all these other other investors are left poor, and their consumption goes down, and that cycle left unchecked leads to potential economic disaster.
So we talk about bank earnings come out this week. Do you have any banks in particular that that you actually do like?
Yeah, let me share my screen here. I'll talk to you about JP Morgan. We've written a couple of reports on JP Morgan. Look, when I first made this a long idea back in May 2020, one of the things I said when I put it on our focus list, one of the things I said is like, this is better than an index fund, Pete, because I think the index has a bunch of junk in it. Like, to your point, there are a lot of these lead steer stocks that are kind of driving markets in general. And those lead steer stocks kind of get more and more amount of money because they're ETF fund flows and all that. And people just kind of pile on. It's a popular Me Too momentum trade that's rotten on the inside because the fundamentals can't back it up. Whereas JP Morgan, I mean, this is just about as solid a company as it can be. It benefits from the bank contagion because it is so well respected. It's a super strong company, from every angle. And then when you look at the valuation, which is what we like to focus on as part of all of our analysis, we can see here first. Let me take another second here to talk about profitability, but the fundamentals of this bank are the best in the business. Goldman Sachs has tended to have really high returns on capital. So for JP Morgan to be even higher than Goldman Sachs, that's a good thing. But then really I like to talk about valuation. I think this is where we really help our clients. People love how we're able to boil this down. Is this big enough for everybody to see? Okay.
Maybe you can make it just a little bigger. It's clear, but a little more might help.
Okay. So what we always like to do, Pete, with respect to any of our target prices or analysis, whether it's a long idea or a short idea, is help people understand how the past profits, right, compare to the profits implied by the stock price. And if we were to do this for a Sweet Green or Beyond Meat or whatever, you'd see a bunch of negative stuff in the past, and you see this huge spike up where ridiculous amount of profits are baked, future profits are baked into the current stock price. JP Morgan, it's the opposite, right? You can see here at the current price of around $129 a share, which is where it was when we wrote this report. I don't remember where it is exactly today, but effectively, the stock price is implying that JP Morgan profits are going to strongly or steeply decline and only maybe recover to where they were back in 2018 or 19. So the current stock price is implying a permanent decline in profits. So then we said, well, instead, why don't we assume, a bit of a decline? Let's just say JP Morgan gets hit by the recession, but they climb out of it a little bit, not quite as steep a decline, and they climb out of it a little bit faster, right? Then you're talking about $157 a share. And I don't think there's another research firm in the world that will be this transparent with you about what it is we're suggesting is a good bet or smart bet, right? And when you look at it, and we'll detail it even more, right? Our forecast suggests that the net operating profit after tax margin falls to 21%. And by the way, it was 27% last year. And they only grow revenue at 4% compounded annually. This is for the next 10 years. That means the stock is worth $157 today. And in that scenario, their profits grows 2% compounded annually over the next 10 years versus the 8% that it's actually done for the last 10 years. So even though we're showing 20% upside here, it's a very conservative outlook. And anyway, just for my money, that's what good research is, right? Let's not just put numbers out there based on bogus numbers. Let's give people something really sound and detailed and mathematically rigorous and reliable on which to base their assumptions and to base their investment decisions.
So you threw the word margin out there. So I want to hop into a different company that is obviously owned by the wealthiest man in the world. At least I think he's the wealthiest right now at the moment, Tesla. So I'm an entrepreneur. I've been an entrepreneur 37 years now. So as soon as somebody starts talking about lowering their prices and having increased competition, my ears go up and I'm like, oh, that's not a good thing. I don't care what's going on. That's not what you don't want to hear the company that you're putting money into, we have more competition and we're also lowering our prices. And to me, the first thing was margins going down, and the market's not liking it since that happened. Even though the deliveries were higher, it's kind of like, oh, we're going to make it up in volume. No, you're not. If your margins are going down, your margins are going down. So let's talk Tesla a little bit, and then maybe something around Tesla, if there's something else to discuss that you like instead or in addition to maybe at this particular time.
Yeah, sure. Let me share the screen here, and I'll go to kind of one of our last more in-depth reports on Tesla. Look, I'm not here to say that electric vehicles are bad, or that Elon Musk is a bad guy, or that Tesla's a bad company. I don't think that's the discussion here. The discussion is around what's the risk reward of owning Tesla stock. Is it a good fundamental investment? And when you look at kind of where things are going from a fundamental perspective, right? Market share is coming down quickly, and especially in the mature markets. So competition is going up quickly, and that's a big deal, right? So the incumbents in aggregate are sort of much bigger already than Tesla is, and it's not Tesla versus just Ford or Tesla versus just GM. It's versus the world, right? Yeah. But then let's cross that with where the valuation is, and we'll use our reverse DCF math here again, right? And one of the things we like to do here before getting to the money chart, which is terrific here, right here, you can see little to no profits. And then this is what they got to do to justify $200 a share. Look at that, right? And that's where Apple is. So if you believe Tesla's worth $200, you believe they're going to be as profitable as Apple. I wouldn't bet on that in a car company. Yeah. And then this is what the implied profits are for different share prices. So 25 and $90. Now, the more important thing to do one of the more important things to take away from this kind of analysis is that we can reverse engineer what kind of car sales are required to justify the price, right? And so we did that here in this analysis, where we analyze, like, in order to justify the current stock price, what kind of vehicle sales are required by 2031, right? And so, and here we point out that for $205 a share, that's 12 million vehicles, right, a year at an ASP of 54,000, right? And where were they in the last year or so? They're around 1 million. Wow. 16 million vehicles at an ASP of 40K, which is equal to General Motors ASP, and then 30 million vehicles at an ASP of 21K, which is equal to Toyota's ASP. Those are some pretty big numbers. Well, let's get a sense of what percentage of market share those numbers imply. More context, right? And I believe the electric vehicle market by the International Energy Association, or whatever the main association is looking for 31 million electric vehicles to be sold a year in 2031. So at 12 million vehicles, that means Tesla current stock price implies they're going to be 37% of the market. At 60 million vehicles, 50% of the market. Or at 30 million vehicles, 95% of the entire electric vehicle market.
Wow.
And that's where it just gets crazy, right? That's the base case scenario. The best case scenario for how many electric vehicles are sold, you can see it's a big jump up. We're still talking pretty ridiculous levels of market share. I think the most amount of market share any one company's ever had of the global vehicle sales market is Toyota. I think they were at 10%. It was 10% at one point, and it didn't last.
Wow, that's a staggering number, especially looking at those now. Wow.
Yeah.
Giving them some context. David, I just want to go back 1 second because I don't want to assume everybody knows the acronyms you were using, ASP and DCF.
Oh, yeah. Average selling price and discounted cash flow model.
Okay. So that's Tesla and where the price could be, should be. What else might we want to look at instead or in addition to?
Yeah, some other stocks we like. GM is on our focus list, and so is Ford. What we love about these companies is they're just the implications for their valuations are extremely low. So GM is trading as if its profits are going to permanently decline by 60%.
Wow.
I think Ford has only got 10% profit growth over the remainder of its life baked into it. The other big thing to notice here is the free cash flow. You got strong and positive free cash flow from Ford and GM, which you do not get in a Tesla, right? Tesla's making things look good, right? Because there can, regulatory credits and cutting down all their R&D. But if you break it down a little farther, Pete, and you look at free cash flow, Tesla is like burning a lot of cash. $2 billion in 2018. They did have a positive year in 2019, but they burned $1 billion in 2020, $1.5 billion in 2021, and $2.25 billion in 2022. So all this talk about profitability, not really true.
Wow.
And that's in stark contrast to what you get in terms of GM and Ford. And while people might say, well, I don't care about that, it doesn't matter. In long term, Tesla's going to do great. I would say no, it's the opposite. When GM and Ford have this effectively war chest of profits and a war chest of a profit generating machine, that just means they're going to be able to compete stronger for longer, right? They can build out better facilities, invest more in R&D, and grow their electric vehicle business over the long term in a way that Tesla can't because they don't have the cash flow.
Wow. Certainly a different perspective for everybody watching this right now or listening.
That's right.
Before, you had mentioned when we were talking about sector rotation, some sectors that had better cash flow than others. Maybe we could finish up with any ideas in that area, if you don't mind.
Yeah, let me go back to this is our Society of Intelligent Investors site, and this is where we kind of pull out some stuff in our research, and we take a lot of questions. And so there's a section here in the S&P 500 where we're just looking at economic book value trends. And I was saying that the S&P looks pretty normal or not moving around a lot, but some sectors look really bad, like utilities. You can see the economic book value. And just to take a second, economic book value is the no growth value of the business. So accounting book value is just that equity number on the balance sheet. And that's a pretty meaningless number these days. Economic book value takes our net operating profit after tax, you divide by cost of capital. So it's sort of a perpetuity value on that NOPAT number. Here you can see, again, economic book value plummeting for utilities, right? For industrials, economic book value actually is looking pretty good in the last quarter. Healthcare, it's actually coming down pretty strongly. Technology, coming down pretty strongly. Real estate, going down. So it's interesting to see, like, there's a big dichotomy. And if you are a client of our research, you can go on the site, and Pete, I probably should have had this up already. So maybe you edit this out. But there's a section of our site where we look at fundamental market and sector trends, and you can do a deep dive into any of the analysis we do across the entire market. So if you wanted to see economic earnings for our all cap index and all of the sectors within that, you click on that report, click on that link, and then open this report, and it will give you a detailed breakout of how economic earnings compare to accounting earnings for the entire market. And then we'll do a detailed breakdown on how that looks at each sector. So we start with basic materials, right? Consumer cyclicals kind of looks the same. So do non-cyclicals. Energy, looking great, right, Pete? That's probably why you guys are rotating into it. Economics and energy are tremendous while the valuation is still pretty muted. Financials, not so bad. Healthcare, it looks like it's turning over a bit. Industrials, again, not as bad as consumer cyclicals and non-cyclicals, but turning over a bit. Notice how GAAP earnings are still looking great. That's a red flag. You got to be careful. That means that some industrial companies are highly manipulating their numbers and some aren't.
We traded a lot of Boeing in the last 6 months, and it's basically been sideways for 15 weeks. Hasn't really moved. Caterpillar's getting hit a little bit harder right now.
Yeah. That's a good example, right? Real estate, again, a tale of two stories, right? GAAP earnings, or FFO, which is more appropriate for REITs, flows funds from operations, and then economic earnings. It's never really been very good. And then technology rolling over a bit too, telecom. Anyway, you get the idea. We're going to break it down for you at a macro level, all the way down to the micro level, where we can break down individual stocks and understand free cash flow, capital turnover, margins, all that.
So Dave, what we'll do, you showed a bunch of stuff on the site there. Obviously, it's newconstructs.com. We'll put all the links to anything that you want to share in the description below the video, so anybody could click through and take it a little bit of a deeper dive. And if anybody has any questions about a lot of the stuff that David either spoke about today or showed, make sure you leave those comments below the video as well, and we'll take those questions, and that'll be part of a follow-up call. That's always the best ones, when it's directly from people that are watching the videos. Beautiful. All right, so David, anything we didn't discuss today, especially with the earnings coming out on banks 2 days from now?
Well, people who know me are gonna get a little bit annoyed by me beating the same drum, and that is, like, do your diligence. Don't just trust that the numbers you're pulling from one side or this side or another have actually looked at the footnotes. Understand, if you're a fiduciary, you have a responsibility to understand the full picture. And that means you are responsible for the footnotes. They are, after all, disclosed. All right. So David Trainer from New Constructs, thank you so much for being with us today. And I really appreciate your time, and I'll speak to you soon. Thank you, Pete. Great being with you. Thank you. Take care now. Thanks, everybody.